But when that comes unwound, money will go somewhere. It's already started to. And I think you're going to see a dramatic move into gold and silver, with silver by far the leader. As it's been actually since September, late September, it's shifted against gold, favoring silver again. And sure enough, since then, you've had that outperformance by silver. So we think that's the main focus for next year on the long side. As far as the short side, basically, you could throw a dart. If it's a paper asset, be careful.
This is Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for December 27th, 2022 through January 3rd, 2023 while supplies last. This week we feature 2022 Silver Kangaroos at just $4.25 over spot. Made by the famed Perth Mint, these 2022 Silver Kangaroos are, along with silver maples, one of the only silver sovereign coins in the world minted at 4 nines fine purity. On one side, they bear the portrait of Queen Elizabeth II, while on the other, they feature the eponymous kangaroo. They come $25 to a tube and just $250 to a box, and at only $4.25 over spot, they're the most affordable box around. And finally, they are IRA eligible. And if you'd like to learn more about a precious metals IRA, call us, and we'll be happy to help you in that process. Our number for all orders is 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend and very popular guest, Michael Oliver from Momentum Structural Analysis. Michael, thank you so much for joining us today.
Hi, Elijah. Good to be here.
Well, it's great to have you, and we're entering into the new year here, 2023. We've had a wild ride in all the markets, it seems like, the stock market, the US dollar, gold and silver. To give kind of a review of the year, what market would you like to start with?
I think that the most important one going forward is going to be gold and silver, with silver in the lead. But we've been noting as the year progressed where we are year to date, because everybody's screaming that everything's going to go down because the Fed's in charge and all this stuff. Well, if they're in charge, how come the Bloomberg's up, 13, 14% on the year? And that's a pullback. How come gold is effectively trading right now with an hour to go left in the day before settlement, down $2 on the year? Okay, and silver's up 3 or 4% on the year. And yet, quote, they're fighting inflation. Well, they are fighting inflation. They're fighting a dozen-year inflation bubble that they created with monetary policy, free money, helicopter money, QEs, you name it. And therefore, all that money went somewhere. And investors and asset managers chose to put it in the stock market back in 2009, which actually, from our perspective, made sense because we turned very bullish in March 2009. In fact, 1 week before the low, we said the low will be around 670. Okay, it was 668, 667 S&P. But then that upside didn't just go up for a couple of years. It went up sevenfold over a dozen years in the S&P. It went up 16-fold for the NASDAQ 100. So it was a bubble like we've never seen in U.S. stock market history. Go back to the 1920s through 1929, doesn't compare in terms of how much up was that bull market before it broke. The dot-com bubble didn't have an advance anywhere near like what we've just seen. The real estate bust that occurred in 2007 and 8 didn't have anything like the advance that we've seen over the last dozen years. So we have a major bubble, and they've broken it. So they have, in fact, fought inflation, if you define inflation properly, meaning broadly. When you increase the money supply, it goes somewhere. Well, investors put it there. However, during this year, you can see that has changed because month by bloody month, the stock market stays down. The NASDAQ's down, 30%, S&P's down about 20%, gold's unchanged. Well, as we've seen the year progress, gold has gone from up on the year, down on the year. It closed last year at 1828, by the way. So it went up a couple $100 early in the year. Then we went down, unchanged on the year. It went down a couple $100. So it's been up a couple $100, down a couple $100. Right now we're right in the middle where we closed a year ago. So some reason, there are good reasons. Some investors, particularly large asset managers, like gold. and they've been moving money out of stocks and into gold. No, gold isn't beating its chest, but gold isn't going down. And silver is actually up on the year. So I think that's a statement. I think gold knows something. Now, what might it know? That the Fed has broken something so huge that they will have to turn and pivot at some point, probably early in this year, to defend certain key assets that are imploding, at key assets from their perspective. You know, they don't care about corn farmers making money. That's bad. Okay. But making money in the stock market or in muni bonds or the paper prices going up, that's okay with them. Well, anyway, those assets are now breaking, not just the stock market, but the bond markets. Even the U.S. government bond market is imploding, has been imploding. In fact, it started before the stock market did. So they're going to have to at some point come in and defend these, quote, essential assets. The problem is that historically, if you go back and look at the broken bubbles, I named several of them, the Fed did come in. For instance, Bernanke pivoted in 2008 and tried to defend the stock market, the real estate arena. They bought mortgage-backed securities. You know, that didn't work because they monopolized the market and turned it into a non-market. And ultimately, the pricing was totally disfigured and chaotic. So they helped implode that market instead of helping it. But they tried to stop the decline, and it didn't work. Why? Because the market ultimately reaches a point at which, if it's created excess, if it's created error in pricing, if those errors have impacted individuals, corporations, municipal governments, state governments, federal governments, in terms of their pricing, their expectations, their spending plans, then those errors get puked out. And you can't stop it. It's nature's way of correcting error. And the Fed created it, but they inevitably cannot stop it. Oh, finally, the bubbles quit breaking, but they usually collapse fully. So that's what we expect this time, except this time we note that it is the biggest bubble in U.S. stock market or paper asset history. So don't expect the normal. Gold knows that. Gold knows that ultimately central banks will have to pivot back to what they do best, which is print, 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 because they have to defend their government bonds. And I think that's what gold knows. And therefore, it's not waiting for Powell to state that. It knows it's going to come. And we'll see data flows that finally will enhance that. Anyway, that I think is the major event of the year, is that shift in asset pricing that's been subtle, but favoring gold and silver.
It's definitely something that you mentioned, that it's subtle, because, you know, gold really hasn't, it's moved up and down. It's pretty much the same as where we started at the beginning of the year. But the fact that it didn't fall, I think, is very significant, as you mentioned, because, you know, pretty much all other asset classes fell. We have seen in the last few months, just last couple months, a huge rally in both gold and especially silver here. Do you see that it's a bit overbought right now, or are we headed higher into next year from here?
There's always potential for short-term counter-trend moves. We think the trend has shifted back favoring gold and silver. We have a few. We don't just come out with, MSA doesn't just come out with one number that says, okay, you cross this, it's the bear market's over, you're going up. There were multiple numbers that gold has emerged above based on momentum structures breaking out. Forget the price charts. Same with silver. We called most of these turns in September and October. You can go back and look where they were at that time, much below here. There's still one more level left in silver and one more level left in gold. It's above the market, but it occurs well before we ever get back to the very obvious highs we've made. Now, in the case of gold, we have two peaks. And by the way, in the history of gold, it's never double topped. So if you think you got a double top, it's never done that. It's always peaked and never come back to its high when it generates a bear market. This time we went back up to 2070 again. Did it in March this year. In other words, we went back up to the high of the summer of 2020, which was also $2,070. Silver has two peaks up there around $30. So if you look at the price chart, you'd say, well, if silver gets back up to 30 and goes through, that's a breakout. If gold gets back up to 2070 and breaks above it, that's a breakout. Well, yeah, that's true, but that's a price chart. We have momentum numbers, momentum-based structures that will break out well before we get back to those numbers. And these are our final buy signal numbers that we'll issue in our reports. Right now, we're basically bullish with one more tier to break through. And we think when that level gets broken through on gold and silver, you'll see a gusher begin. Meaning no longer a timid advance, but something very dramatic, a tonal change in both markets. But your question was, is there potential for pullback? Yes. We see potential sometime in this quarter maybe to have silver drop back down in the lower 23s again, which is to say drop 3% from where it is right now. We see the potential for gold to maybe drop a couple percent from where it is right now. But that's about it. So we do see the potential always for counter trend moves, but we think you should basically ignore those if you're an investor. You should be looking at the larger context. And as far as we're concerned, if one's in those markets, you should be in now, okay? And there's one more tier that we've got to break through. And once we break through that, we think that's it. That's the final green light. And that will be in our reports.
I think it might be a bit difficult right now if we're, looking at silver at 24 and gold at 1800, and just a few months ago it was 16 something and silver was 17, 18. It might be hard for our viewers to think, well, now's the time to buy, but it sounds like what you're saying is the trend has started. We might see a bit of a dip, but really in your perspective, it's up from here.
Yeah, with one more breakout level, we had like 3 or 4 tiers that we broke through, and consider it starting gates. No one holy number, but levels on different time scales of our trend assessment that broke through, and these are back at levels well below here, like in the $18, $19 area in silver and upper 1600s in gold, for example. We had some major breakouts. So no, we're not saying buy it here. We said buy it below here. But on the other hand, if you're not long, you better consider it because there's only one more starting gate left. And when we break through that one, we think the tonal change in the markets will be surprising and people will have to chase it at that point. And we think it could be very dramatic. And we see the fundamentals for it as well because we think the Fed has broken the biggest asset bubble in U.S. stock market history. And the consequences of that will cause panic on the part of central banks, not just the Fed.
And I know, forgive me if I'm wrong, but I believe this year you started looking at the U.S. dollar index. Can you give us an update on that, why you started looking at that again? And I know one of the things that you said in a previous interview was you were looking for a waterfall decline in it. We have seen quite a bit of a decline in the dollar index, but do you see it declining further from here?
Yeah, there's the dollar index compared to gold is not a good inverse relationship. If you go back 50 years and overlay a chart, monthly bar chart of the dollar index and gold, you'll find there's periods of time, including multiple years, where basically they both went up together or down together. Not dramatically, but, in similar sync. So they really weren't good inverse. Now, there are periods of time where there is a closer inverse relationship, and we've seen that this year, especially starting around March when gold made its high at 2,078, I think was the price. That was in March. That's when the dollar emerged up through some momentum structures that we had. Not very long term, but enough to cause the rally. And also, if you look at a dollar index price chart, go back to 2015, there was a bull market there that ended, that we called in 2012, that we went from like 70 on the dollar index to 100, and at that point we went neutral. Dollar index started to go sideways. And actually, from December of 2015, the dollar index was at 96 or 98 something, and gold was down at 1,050. Gold doubled in price from its December 2015 low to its summer 2020 high, and yet the dollar index was in a sideways range. So again, the correlation was not very good. You didn't have a weak dollar, and yet gold doubled. But since March of this year, they have been in very strong inverse relationship. The dollar index reached near 115 several months back. When it dropped back down under 111, we had momentum trend breakage. Not price breakage, but momentum trend said, that's it. That was probably the top. You're going down. And we thought it would go down to about 103.5 area. There were certain reasons for that. One of the obvious reasons for that is price-based, which we don't particularly like, but most people do. Okay, meaning there were two price highs in the dollar index. One was in 2017 at 103 plus, above 103.5, but not up to 104. Okay, then in March of 2020, during the stock market panic, if you recall, the dollar surged again, and it reached up to 103.5, but not 104. So there's a little window in there where it peaked 2 times. So it's only natural that when you drop from our sell level just below 111, we thought you might find support around 103.5. And sure enough, it's found support there, because anybody with a ruler and a crayon can draw a line across those 2 price chart highs and say, gee, this must be support. What's interesting is that they've been buying it there between 103.5 and 104 for the last 3 weeks. And they're not making any money. Yeah, they're buying support, but so far the guys who are buying it there at this bleeding obvious level aren't making money. So it wouldn't shock us that we stop them out, meaning you plunge the dollar a bit more. And then maybe you can get a rally in the dollar up to 105, maybe 106 or something. It's a counter trend rally. Don't be confused by it. And that might also be coincident with some kind of pullback in gold. But again, it's counter trend. It is not to be heeded as something significant. The dollar, we think, is broken. We think it'll be more broken once the price guys realize that their double tops at 103.5 area don't hold. That's when they're going to start pulling their hair out saying, oh, my goodness, what's going on here? And we think the dollar then will enter a downside trajectory with more significance.
Now, when it comes to this shift that we're seeing, and we've seen this year with gold not falling, for the whole year, it's pretty much even, but the stock market falling, and we're seeing a renewed interest in precious metals and movement out of the stock market. Who is doing this, do you think? What are the players? I know there's been a lot of accumulation by central banks. Do you see those being the main players? Do you see just individual investors? Who are the big players in this market right now?
I won't specifically name funds, but there's some big name hedge fund and asset managers out there who you see on CNBC who for many months said, hey, this stock market thing is not good. And they've started to move money out of that, perceiving it to be not a good risk-reward arena anymore. And they haven't gone into bonds. Bonds have imploded more than the stock market even. So they didn't go into paper assets, but they clearly moved into gold. And some of them have stated this outright, that they favor gold because they see what I said is a likely outcome, that the central banks will have to, again, reverse due to reality back to what they're intended to do, namely buy their government bonds when their government bonds become under stress. And even our Secretary of Treasury has declared a few months ago that the U.S. government bond market has become illiquid. Oh, that's the worst word you can use in a market. Not that it's going down, but it's illiquid. When something becomes illiquid, it's highly dangerous. And to say that the U.S. government bond market has become illiquid is probably the most dangerous statement she could have made. But she was fair when she made it. And I think that is the key issue, because if that situation and the paper asset implosion continues, which we think it will, then they're going to have to reverse. Now, I don't know how they're going to do it intellectually, without admitting, oh, gosh, we were wrong again. But I suspect they're going to lose credibility over time among outside economists, many of whom were pro-Fed people who've now said, oh, the Fed's gone down the wrong course, gone too far. And suddenly the Fed will no longer have the respect that it's had, which it shouldn't have had in the first place, because generally it creates the boom-bust cycles. It's not the shepherd that keeps them orderly. It's the one that creates the situations. And I think that's the situation we face. And I think some large asset managers, not just central banks around the world, as you've noted, have acquired gold. But I think it's some large asset managers who've made shifts into that arena because they perceive it to be either one, a positive situation, or certainly a less risky situation.
You mentioned central banks are losing credibility right now. We are seeing the Fed reduce the rate of increase. What do you see for them coming in 2023? Do you think that'll be the year that they actually pivot and reverse course back to easing?
I think they'll have to, because I don't see the trend events in the market. The NASDAQ 100, the S&P 500. We also watch the big three stocks, Apple, Amazon, and Microsoft is our big three. And you got to realize NASDAQ 100, it went up 16-fold, while the S&P went up 7-fold. So you talk about a bubble, okay? It doesn't compare to .com. And our measurement of the breakage that has already occurred is you're nowhere near levels that would justify starting to even talk about possible basing action. Anything you see on price that appears to be an attempt to hold is merely an attempt to hold. There were several of these patterns back in 2008, by the way, on the way down. After we topped in 2007, there was a sharp drop into early 2008. And it was a rally from the January, March lows of 2008 back up to May that really was impressive to most chart watchers. We didn't like it, but it took you back unchanged on the year. And then came the onslaught later in 2008. And we think the onslaught is about to begin in 2023. That 2022 was merely the beginning. And that, we still hear on CNBC and Fox Business, for example, chatter about bottoming, possible bottoming. They're using the word bottom. When they quit using the word bottom, maybe start to pay attention. But everybody's still chattering about whether this is a bottom or not a bottom. The fact that they're even discussing the issue means that they don't perceive the reality that we think is underway. And we don't think the Fed realizes it either. They will realize it later in 2023. And I think at that point, after the events occur, in other words, gold's not going to wait for some announcement from Powell that says, well, we're going to stop raising rates for a while, or, he'll have to transition in some way. Gold will see the events that are occurring in key assets and know what the central bank response will have to be. And we'll go ahead and move before the central bank even tells you. Gold is an anticipatory, it's been around thousands of years. It's not like some new market that just, came into being. It's a wise market. It's global. And it's perhaps the wisest market out there. And maybe that's why it didn't go down this year, because it knows what's coming.
Yeah, no, buy the rumor, sell the news, right?
Gold doesn't move on headlines. It anticipates them.
Any last thoughts for 2023, what you're anticipating, the risks out there that people should be considering right now?
Well, in general, the stock market, we think, has only begun its decline. We think it'll be quite serious. If I had I don't have any downside numbers, frankly. People have asked me that. I don't have a target except to say that this should be the worst bubble unraveling that we've ever seen in U.S. stock market history, simply due to the age and the severity of the upside, percentage-wise. That when it comes undone, and it's not like everything got better after 2009 in the sense of reality got better. Monetary policy got so loose that we printed our way out of the hole. And therefore, the money had to flow somewhere. They printed, it went somewhere. Asset managers put it into stocks. And as is usually the case, they stayed too long. Therefore, you had the excess. But when that comes unwound, money will go somewhere. It's already started to. And I think you're going to see a dramatic move into gold and silver, with silver by far the leader. As it's been actually since September, late September, it's shifted against gold, favoring silver again. And sure enough, since then, you've had that outperformance by silver. So we think that's the main focus for next year on the long side. As far as the short side, basically, you could throw a dart. If it's a paper asset, be careful.
All right. Well, it'll definitely be interesting to see 2023 and continue to track this with you, Michael. Thank you so much for your time. If our viewers are interested in learning more, they can go sign up at olivermsa.com. Any last thoughts before we let you go? And can you tell us a bit about momentum structural analysis? There
was an article on us written in the Wall Street Journal in Christmas issue of December 2015 that focused just on our method. And they summed it up pretty well. They said that we tend to look at long-term technicals, but not price charts. We look at long-term momentum trends. And we don't mean wet noodle type indicators, but stuff that when you plot, looks like a price chart where there's bars and you can draw lines and there's structures. And quite often, momentum, in fact, most of the time, 90+% of the time, if there's a trend change to come, whether a top or a bottom, momentum will tell you before price does. You'll see it coming. Much like when you see a price chart topping pattern, everybody can recognize, head and shoulder top, all that kind of thing. You see that on momentum months before the price action of the market says, oh, we're going down, we're going up. And so that's what we do, is we focus on technicals, but momentum technicals before price. And we think that gives our subscribers some advantage.
Fantastic. Well, Michael, we really always appreciate you coming on here. Thank you once again, and Happy New Year.
Same to you, Elijah. Great.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.